Hello and welcome to today's video. Today I will be covering an interesting AI play stock called UiPath. I was looking for the long time to get an exposure to a promising AI play, especially with all these hyperscalers spending in capex in the last 2 years. If you are looking for a solid investment broker, I personally use Interactive Brokers. They have decent platform with great mobile apps, stocks, ETFs, options are just to name a few optionalities they offer, combined with low fees of course. Use my link in the description of the video to earn up to $1,000 in their stock. Now disclaimer. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. UiPath is a leading software company specializing in robotic process automation, enabling enterprises to automate repetitive tasks and streamline business processes. With almost 11,000 customers in its pipeline, led by key man CEO Daniel Dines. They have also initiated pilot testing for agentic automation, where agents can independently manage dynamic and unstructured environments, potentially emerging as their next major revenue growth driver. The company targets key industries such as finance, healthcare, and manufacturing, among many others. Their platform supports integration with any large language model, allowing enterprises to choose the one best suited to their specific needs. When examining their ecosystem partners, some interesting interconnections emerge. For example, the partnership between UiPath and ChatGPT enables UiPath to leverage OpenAI's LLM while also facilitating orchestration for enterprises that require ChatGPT services. Recently, companies like PayPal have struck deals with ChatGPT to serve as a payment provider for agentic commerce on their platform. As ChatGPT expands to other enterprises where AI agents will handle purchases using their services, the underlying intelligence will be powered by ChatGPT. System rules will be defined by companies like SAP, and UiPath will enable those actions to execute across various systems. This is just one theoretical example of interoperability among these companies, offering a glimpse into the myriad other interconnections that could emerge in the future, fueled by advancements in AI. Now onto their latest development, agnostic or all-seeing Maestro platform. It's an AI-driven orchestration platform that coordinates how humans, robots, and AI agents work together across an enterprise. Until recently, automation was dominated by robotic process automation, which excelled at simple, repetitive, rule-based tasks. In these workflows, the priority is reliability, the ability to execute the same action thousands of times without deviation or error. Now, automation is expanding into more complex, non-rule-based tasks that require reasoning, judgment, and problem solving. This is where AI agents come in. By leveraging large language models as their brain, agents can now interpret context, make decisions, and adapt to new situations. However, while agents are intelligent, they are not always reliable. If you ask them to perform the same simple task repeatedly, they can drift or introduce unnecessary changes. This is something at least I have experienced firsthand when using tools like ChatGPT for planning. It often performs well initially, but over time it may alter things without a clear reason, and sometimes in ways that move you further away from your original goal. That's why agentic automation and robotic automation are complementary rather than competing approaches. Agents provide flexibility and intelligence, while robots provide structure and consistency. Crucially, humans must remain in control. The real challenge and the real opportunity lies in the seamless interoperability between humans, robots, and agents. This is exactly the problem Maestro is designed to solve, orchestrating these different actors into a coherent, governed, and scalable enterprise workflow. Now onto some their key performance indicators. We have annualized renewal run rate, which represents the annual value of a company's recurring subscription business based on a current customer contracts. It assumes that all existing customers continue paying the same subscription amounts for the next year, without any upgrades, downgrades, or cancellation. Annualized renewal run rate is a snapshot of recurring demand, not a forecast of future revenue. Then following that, we have dollar-based net retention rate, which measures how much recurring revenue a company generates from the same customers compared to a year ago. It shows whether existing customers are spending more, the same, or less over time. A rate above 100% means customers are expanding their usage and spending more, while a rate below 100% indicates contraction or churn. Importantly, it excludes revenue from new customers and focuses only on the behavior of the existing customer base. Now on to competition. So competition is fierce in this space, especially when compared to giants like Microsoft, Oracle, ServiceNow, among many other prominent names, yet it certainly helps to be recognized as a leader in reports from Everest Group and Gartner. Names like Microsoft are a heavyweight in this space, no doubt, but UiPath is not competing head-on, it is positioning itself as an orchestration layer. The recent integration with Microsoft Azure AI Foundry shows UiPath carving out its own role by enabling governed end-to-end workflows that span both UiPath and Microsoft AI agents, reinforcing its relevance rather than being displaced by Microsoft's stack. A similar argument was once made about Bitcoin miners expanding its data centers infrastructure. The concern was that they were entering a space they could never win, as competing with giants like Google or Microsoft seemed unrealistic. Looking back, that view proved too narrow. Those same hyperscalers went on to sign large capacity and hosting deals with companies like Iron, Cypher Mining and TeraWulf. Rather than clashing directly, miners became extension arms of the hyperscalers, which translated into strong share price performance across the sector in 2025. The same logic applies here. Competition does not always mean displacement. In many cases, it creates room for collaboration where both sides benefit. Think about it, who is better positioned to operate large-scale data centers than Bitcoin miners, who have spent years power-intensive, always-on infrastructure at scale? In the same way, who is better suited to implement agentic AI automation than a company that already has deep experience delivering robotic process automation across real enterprise workflows? Existing expertise matters, and in both cases it becomes a natural advantage rather than a weakness. The quote above illustrates that despite intense competition and high level of innovation in this space, UiPath is clearly positioning itself differently. Rather than competing head-to-head with individual platforms, it aims to act as an orchestration layer that sits above them. This is where UiPath's potential strength becomes visible. Its value does not come from replacing existing systems, but from connecting them and enabling them to operate as one. In that sense, UiPath functions like a nervous system, coordinating the brain and muscles rather than trying to be either one itself. In this proof of concept, UiPath's Maestro platform was in control, coordinating integrated services such as ServiceNow, Confluence, and specialized LLMs. Each system retained its native role, while Maestro managed how and when they work together within a single end-to-end workflow. If executed well, this orchestration-first positioning could allow UiPath to coexist with the competitors while becoming increasingly embedded in enterprise operations over time. Recently, I listened to an interview with Bill McDermott, CEO of ServiceNow, the company which I see as a direct competitor. The discovery from my side relates to his background, which is sales-led, while UiPath is led by its founder Daniel Dines, who comes from an engineering background. Both leadership styles are essential for long-term success, but in different phases of a company's life cycle. In the AI and agentic automation revolution, the probability of an aha moment or discovering something fundamentally new is higher with an engineering-led CEO than with a sales-led one. That's also one of my anchors why I favor UiPath compared to their competition. Some of you might be surprised by this point, so one of my points of concern is also profitability. So it is worth breaking down in more detail. The company will most likely finish this year profitable. However, this outcome is largely driven by tax benefits. These benefits are accounting in nature and are not something that occurs regularly within the core business. For that reason, I prefer to look at profitability excluding one-time or non-recurring items, as this provides a clearer picture of the company underlying operating performance and its true path to sustainable profitability. Importantly, the company has already generated pre-tax profits in certain periods, even without the contribution of tax benefit. While profitability is not yet consistent across all quarters, this demonstrates that the core business can operate in the profit under the right conditions. When a company has not yet reached full sustainable profitability, key performance indicators such as annual renewal rate and dollar-based net retention rate becomes especially important to monitor. UiPath reported ARR growth of 11% year over year, while its dollar-based net retention rate stands at 107%. Annual renewal rate growth shows that the subscription base is still expanding, but the quality of the growth is best assessed throughout retention. A dollar-based net retention rate above 100% is critical, as it indicates that existing customers are spending more over time, offsetting the churn. However, it is not enough for this metric to simply remain above 100%. As shown by the graphic above, it has been in constant decline since Q1 of 2022. We need to see an inflection point in that regard to demonstrate that the business can scale revenues and eventually profitability without relying heavily on constant new customer acquisition. From the management commentary, the biggest pressure is currently coming from the lower cohort of customers. Maestro launch could be exactly the catalyst for much needed inflection. This matters because sales and marketing expenses remain elevated and continue to absorb a large portion of potential profits despite despite otherwise strong gross margins. That dynamic is typical for enterprise software as a service companies such as Palantir and UiPath at this stage of maturity. Looking ahead, AI-driven automation represents a potential inflection point. Many of these solutions are still pilot phases, but broader adoption could increase customer stickiness and drive upsell across the existing base. If that materializes, it would validate UiPath's operating model by pushing retention higher and improving operating leverage over time. While the CEO's continued share sales are not particularly encouraging, especially in these times, they should be viewed in the context of his compensation structure. Despite the ongoing selling, the CEO still owns just under 38 million shares, representing a substantial ownership stake and meaningful skin in the game, which helps align his long-term incentives with those of shareholders. Importantly, his base salary is minimal, with the majority of his compensation tied to equity, making periodic share sales a rational mechanism for liquidity rather than a signal of reduced confidence. Now on to things that makes this company interesting to me. So first, technicals. So compared to the most peers in its space, Path has been heavily derated, with the current share price trading only about 40% above its all-time low. From my perspective, this creates an attractive risk to reward setup, particularly given the downside relative to the potential upside. Technically, the stock has also begun to show early signs of trend reversal, with a developing sequence of higher lows and higher highs on the weekly time frame. Next is valuation. So companies that are not yet fully profitable or are only beginning to approach profitability are inherently difficult to evaluate, as their business models have not yet been fully proven. As such, my stance here is based on UiPath's improving fundamentals and its strategic pivot towards agentic AI automation, which could represent an inflection point. This shift has the potential not only to attract new customers, but also to deepen engagement with existing ones throughout incremental upsells across its platform. A useful comparison here is Palantir. Palantir ultimately demonstrated to the market that its business model works, following a similar early trajectory characterized by strong gross margins and heavy spending on sales and marketing. That strategy resulted in net losses for several years, but once the inflection point was reached, the re-rating in the stock fundamentally changed outcomes for investors who had conviction early on. It's fair to argue that Palantir's current valuation multiples appear stretched, particularly when compared to companies such as Microsoft, which generates revenue at entirely different scale while trading at much lower price to sales multiple. However, that comparison is not the core point of this analysis. Markets have repeatedly shown a tendency to both drastically undervalue companies before inflection points and overvalue them once momentum takes hold. If one assumes that UiPath is approaching a similar inflection point to Palantir's, the current valuation becomes more compelling, with Path trading at roughly 5 times price to sales multiple. A hypothetical re-rating to levels seen during Palantir's growth phase would imply substantial upside, while a one-to-one replication of Palantir's price action is highly unlikely. Even capturing a fraction of that multiple expansion could result in meaningful returns. From this perspective, a significant increase in the share price does not appear unrealistic if execution continues to improve and the agentic AI strategy delivers in becoming the next big thing in the AI development revolution. Higher multiples may be achievable over time, but even without assuming an aggressive re-rating, the upside becomes visible from a more conservative perspective. If you look at one of UiPath's closest peers, from my view, ServiceNow, we have an interesting comparison. ServiceNow currently trades at a market capitalization of roughly 138 billion, which places it at a price to sales multiple of about 10.61. UiPath, by contrast, trades at a price to sales multiple of approximately 5.2. If UiPath were to trade at the same multiple as ServiceNow, this would imply upside potential of roughly 106% from current levels. This does not require UiPath to become automatic winner overnight, only that market begins to value it closer to peers. To be fair, ServiceNow is already highly profitable and has completed a 5-to-1 stock split, reflecting both scale and market confidence. If we assume UiPath can successfully transition to sustained profitability over the long term, then a valuation framework closer to ServiceNow does not appear unrealistic. To their financials, so coupled with improving fundamentals across the business, another aspect I find particularly attractive is UiPath's strong balance sheet. The company currently holds approximately 1.5 billion in cash, which relative to its market capitalization is around 7.9 billion. This means that roughly 19% of the market cap is backed by cash alone. In practical terms, for every $1 invested in the stock, investors are effectively getting about $0.19 in cash, a dynamic that becomes even more compelling if the share price continues to decline. While stock-based compensation remains elevated, this is largely expected for a company still in the process of proving its long-term potential, as equity initiatives are one of the most effective tools for attracting and retaining top-tier talent. Importantly, the company carries no debt, removing balance sheet risk from the equation automation and providing additional financial flexibility. When comparing UiPath to its competition, the balance sheet differences stand out. Oracle has debt that is roughly 6 times higher than its cash position. SAP operates with a 1-to-1 cash to debt ratio, which reduces its attractiveness when viewed relative to its market capitalization, and ServiceNow trades at roughly 46 times its cash position when compared to its market cap. While holding a large cash balance does not automatically create competitive advantage, it does improve financial flexibility and downside protection. From this perspective, UiPath stands out as a company that trades at roughly 5 times its cash liquidity. This balance sheet strength improves UiPath's risk-reward profile relative to peers and provides optionality without the need for external financing. Next thing is the total addressable market is effectively measured in trillions. Any business that relies on digital services is a potential customer, and the long-term direction of the global economy is clearly moving toward deeper digital automation. That said, a massive TAM does not automatically translate into massive revenue. Capturing market share is a very different challenge. Execution, product differentiation, trust, and enterprise adoption all determine how much of that opportunity a company can realistically convert into actual sales. Another aspect I find compelling about this business is its symbiotic nature in a positive sense. Once an organization integrates software that automates and orchestrates its workflows, that software becomes deeply embedded in how the company operates. Over time, teams adapt to it, build processes around it, and develop habits that depend on it. Humans are creatures of habit, and once a workflow becomes familiar and reliable, changing it later becomes costly not only financially but also operationally and culturally. From this perspective, once an enterprise develops trust in the platform, there is a high probability it remains a long-term customer, provided the software continues to innovate and stays at the forefront of the industry. As long as the platform does not fall behind technologically, this embedded position creates strong switching costs and durable customer relationships. The key takeaway here is not what management is excluding from the guidance, but why. Despite highlighting progress and early traction in agentic automation, the company is deliberately not baking any meaningful revenue contribution from this segment into its forward projections. This is precisely where the opportunity lies. Management is signaling technological and customer progress while simultaneously setting expectations conservatively from a revenue standpoint. That disconnect creates potential upside. If or when agentic automation begins to scale, future revenue growth could surprise to the upside before it is fully reflected in consensus estimates. In other words, management may be giving that market the early insight into where the business is heading without yet asking investors to pay for it. This creates an opportunity to position ahead of the point where agentic automation starts to show up materially in reported numbers. Lastly, some closing thoughts. So researching UiPath was compelling for me, and I believe the potential becomes clear after working throughout the analysis. The target market for agentic automation is vast, effectively encompassing every mid-size and large enterprise that wants to improve efficiency, reduce friction, and scale operations in an increasingly digital world. UiPath stands out by positioning itself as an orchestration layer rather than a single-point solution. Its strength lies in its ability to connect existing RPA systems, AI agents, and human workflows, enabling them to operate together across both simple and complex tasks over time. Instead of replacing what enterprises already use, UiPath aims to unify it. From my perspective, the two biggest risks are execution and competition. On execution side, UiPath's decade-long experience in RPAs combined with a culture built early and reinforced over time provides a meaningful advantage. The return of a vision-led founder as CEO further strengthens confidence in the company's ability to execute on its long-term roadmap. Competition remains the part of this thesis I'm still not fully at peace with, largely because it is genuinely intense. When I look at the companies like Duolingo, I struggle to identify a competitor operating in the same category with comparable scale and product strength. In UiPath's case, the clarity does not exist. Familiar names keep resurfacing, and while there are solid arguments that these companies operate at different layers of the enterprise stack, the overlap is still uncomfortable. Maybe this changes as I do more research. Take ServiceNow, for example. On its most recent earnings call, management also emphasized automation across enterprise workflows. They even referenced feedback from customers who choose to abandon pilot projects and move directly onto ServiceNow platform. However, my takeaway from that call was not just about automation but about control. ServiceNow appears intent on keeping as much of the workflow logic and execution as possible within its own platform, even while using language such as cross-enterprise and connected work. In practice, this still points towards a strategy centered on platform consolidation and ecosystem lock-in. This is where UiPath stands apart. Rather than competing head-on with every software platform, it focuses on providing the underlying infrastructure that allows multiple tools, robots, and agents to work together to solve complex problems. If successful, this approach could secure UiPath's a durable position among the leaders of the ongoing AI revolution. UiPath's upside ultimately depends on how you view the future of enterprise software. If the world stays more closed single-vendor platforms, UiPath's potential is more limited. If instead the future favors openness, modularity, and interoperability, UiPath's opportunity becomes significantly more compelling. With the stock currently trading at depressed levels, the market appears to be pricing in the risks while assigning little value to the potential upside from agentic automation. For long-term investors, this creates an interesting opportunity to take on those risks in exchange for a potentially asymmetric upside over time, assuming that the Maestro project converts from small pilots and theory into practice. Okay, this is it for today's video. If you want more deep dives, check my Substack. Also, for more daily insights and market updates, check my X account. And for more educational content, you can check my website. Like, subscribe as a sign of support, as a lot of time is taken to make this kind of the video. Share it to others and nothing. Watch yourself and see you in the next video. Bye.